Hey there, it is Corey here, CEO at Verse Wealth, and I'm joined, as I normally am, by Tom Schubert, Managing Partner at award-winning asset manager Drummond Capital, for our quarterly market and economic update. Tom, thank you for joining us.
Thanks for having me, Corey.
You are most welcome. Now, there's plenty to get to. It's been a bit of a wild week on investment markets. We've seen plenty of somewhat concerning and or sensational headlines. So we'll probably start there with the conversation today. What has been happening there? What's behind the pullback? How should clients or investors be thinking about that? We'll transition from there and have a bit of a chat about the Australian economy. We'll be talking about inflation, which has been something we've been chatting about for a number of years now. We'll be talking about interest rates and what's happening there, and how perhaps the goalposts are shifting on when we might begin to see rate cuts from the RBA. We'll have a bit of a chat about the US economy and how they're progressing. They have made headlines themselves. This week, there is some talk of a potential recession in the US. So I'm keen to get your views on that, Tom, how realistic that is or how overblown that potentially might be. So plenty to get through if you're happy to dive in, Tom.
Sounds great.
Great. So let's take it from the top. So start of this week, we saw some pretty significant falls on investment markets globally, really kind of led by Japan. The Nikkei was consuming most of the headlines. They had a 12% fall in one trading day. I think that might have been Monday, perhaps. They've rebounded a little bit since then, but the flow-on effect has been to other global markets, ours included. So this is really the first pullback we've seen in some time on investment markets. So tell us a little bit about what has been the catalyst for those recent falls or that pullback, and how should people be thinking about it?
Sure. So yeah, Japan has been a big source of the volatility and sort of what triggered that, I guess. So Japan's been one of the few markets where they've kept interest rates at zero. So in the last few years, we've seen central banks all around the world hiking rates back to the more normal levels that we currently set at today. Japan has been at zero or negative now for decades, since the 90s, since they had their collapse at the end of the 80s. And so they've kept it pinned at zero, really trying to get growth and inflation started. And it sort of kicked off. And a couple of weeks ago, for the first time, Japan actually raised interest rates to 0.25%. But as a result of keeping rates really low, Japanese investors and global investors have essentially been doing what's called the carry trade. You may or may not see that in the headline. What does that mean? Essentially, you're selling Japanese yen or borrowing in Japanese yen and investing in US markets, whether it's equities or Australia, into our bonds, where you're earning potentially higher return than zero, which is a pretty low rate in your home market. And so all of that selling of the yen and selling of Japan and buying of the world has gone on for some time, and the yen's been very weak. Anyone who's been to Japan for a holiday recently or knows someone who's been will tell you just how cheap it is to go there, and that's as a result of a very weak currency. What happened when they raised interest rates for the first time, sort of combined last week with some weaker data out of the US, and I know you said we'll touch on the US economy, but signs that potentially the US is getting closer to cutting interest rates. That differential between the two triggered a big reversal in that trade. So investors went, maybe we don't want to have so much carry trade exposure, and they sold their assets overseas and took them back to pay back those loans in Japan. And it happened quite quickly. Often they're leverage trades, there's borrowing involved. And when there's borrowing involved, we see often quite sharp moves. Fortunately, so Japan, top to bottom was down 25%. Equally, yesterday, the government stepped in, the central banks now stepped in. Japan was up 9% yesterday, it's up another 3% today. So it's already recovered some of those really significant losses, but that volatility is certainly reverberated around the world. For context, though, in terms of what it means for our investors and for domestic investors in Australia, it's far more moderate. And in a normal year, even in bull markets, we see these sort of reversals. Markets go up, lots of optimism, things all look pretty good. You get things out of left field, in this case, the Japanese issue, maybe it's some concerns over war. little bit of uncertainty builds up and investors take profits and you get a correction. And usually that's anywhere between sort of 5 and 10%, peak to trough decline in markets. So for context, that's very normal. It happens in most years. And if we look at the MSCI World, the global equity index as a whole, peak to trough, it was down 8, the US market down 8, the Aussie market down 6. So absolutely normal. If you're a Japanese equity investor, a bit more painful. But fortunately for us, we don't have direct investments in Japan or any real direct Asian exposure. And so largely been isolated. And again, for context, July, it was a really good financial year for portfolios and for markets, double-digit returns. July was another solid month, up sort of 2 to 3%.
Yep.
And month to date, all that's really happened is you've given back that July return and you're back to where you were at the end of the financial year. So I think in the grand scheme of things, probably nothing like what the headlines suggest. And some things are changing, but there's no kind of pattern. There shouldn't be any panic. The media just likes to put the big headlines out. Certainly Japan is a big thing. We get that.
Yeah, no, that's a good summation, Tom. And even despite those falls, markets are still up for the year. The All Ordinaries, which is our 500 largest companies, we're up 5-6% for the last 12 months, despite, the losses of the last, week or so, or this month. The S&P 500, so back to the US, they're 500 largest companies. They're in a pretty solid and long sustained bull market. They're up 80% for the last 5 years. So when we see these corrections or pullbacks, and the words can be used interchangeably here, this is just healthy market behavior, and it does capture headlines. And I think for those that aren't as well informed or don't have necessarily well embedded investment philosophies, it can be a cause of concern naturally when you see some of the headlines and some of the hysteria. But this is why people have advisors, and while we talk to you once a quarter, just to help people zoom out a little bit and give them some more perspective. One thing I do want to zoom in on a little bit, when we've been catching up for some time, we've been talking about US markets, in particular technology stocks, and how they are now a large portion of the overall market weighting in the US, and how they in particular have been driving some of these share market gains the US have put on in recent times. And within those technology stocks, artificial intelligence, AI, has certainly been a theme, and will be, it'll be a 5, 10, 15, 20-year theme from here going forward, but is potentially part of this, sell-off we've seen, related to the fact that maybe those AI-led stocks have been a little bit overdone and they've been a little bit stretched in terms of their value, and some of that is just coming back to maybe a more appropriate price.
Look, that's a really solid observation. I think the last year, if you look at those tech stocks in particular, they've led the market higher, and a lot of that's been driven on fundamental earnings. So AI, the theme, the advancements, ChatGPT at the start of last year drove a huge cycle in earnings upgrades for all of those companies. Everyone's now trying to integrate AI into their business and personal lives, and to do that are buying more services from Amazon or Google or Microsoft, who are buying more chips to power it. So it's been a real cycle in terms of earnings for these companies. And initially, what happens, everyone underestimates how good the upside is, and so every quarter, up until the last quarter, we've seen estimates for their earnings here, and the companies come in and exceed. And when that happens in markets, that's what drives the stock prices higher, sort of playing catch up to what's actually taking place. And then what happens, everyone's an expert and everyone loves the theme, and we're all talking about AI. And so in the last quarter, these companies delivered good earnings, but the problem was that their expectations had been built up a lot more. So instead of exceeding, they were slightly missing on the expectations that had been built into the market. And so that created a little bit of volatility as well, and seen some profit taking. To sort of go back to earlier points, though, things like Nvidia, which has been a poster child, is still up well over 100% over the year. So it's kind of natural that there's a little bit of profit taking when the growth just starts to slow down a little bit. But these companies, they're not in a bubble in the sense that they're not cheap, but they're certainly generating real earnings growth and continue to generate real earnings growth from the growth in artificial intelligence. And if we look at them compared to the 2000 tech bubble, it's a very different story. Back then the top 10 tech stocks were valued at 60 times with very little earnings. The top 10 now are sort of 27 times, but actually they've still strong earnings growth out over the next few years. So they're not cheap, but they're supported by strong fundamentals.
Yeah, well said. Yeah, they're not cheap and they shouldn't be because they've got really strong growth prospects. And trying to value a company like that has, potentially exponential growth prospects is difficult. And there's a greater risk of at times, that company or that part of the market, being more inclined to being overvalued, which is only natural. Shifting gears a little bit to coming back home here to the Australian economy. The Reserve Bank met, when did they meet? Yesterday, the first Tuesday of the month. And, there's been quite a few headlines on the back of yesterday's meeting on the basis that the RBA Governor, Michelle Bullock, has said inflation remains too high. And essentially on that basis, we don't see any near-term interest rate cuts on their agenda. There had been some talk and expectation for a while now that, in the back half of 2024, we might begin to see rates cut. That's now looking less likely than likely. So maybe just give us a bit more detail around what actually is happening with inflation. Why has the RBA said what they've said, and how should we be thinking about it?
Yeah, so the inflation in Australia stayed a little bit stickier. In we look around the world, it has been moderating back towards the target in most major economies. And so we've seen rate cuts commence in Canada, Europe, UK, New Zealand. We're probably getting closer in the US. We can talk about that in a sec. But Australia, hasn't been in that position because inflation has stayed above the target that the RBA has, which is 2 to 3%. And a big driver of that, this is some of the headlines today, is the RBA keeps telling the government, you are spending too much. State governments and federal government are still undertaking pretty big fiscal programs, whether that's through NDIS, infrastructure programs, cash handouts for, cost of living measures, etc. They're still putting a lot of money through the economy and increasing those measures every half in the various budgets that they roll out. And so they keep telling the government, you want us to ease interest rates, you need to slow down your spending. And they disagree, but of course they do. So that's been part of the issue. I think yesterday, Governor Bullock got painted into a corner a little bit when asked about the rate cuts, saying, we won't have any for 6 months. If we sort of cycle forward a few months and every central bank around the world's easing, growth has slowed a little bit. But retail was quite weak in Australia, and we maybe get towards, November, December, then they have a gap. They don't meet in January, so the next one's February. I wouldn't be surprised if you see a cheeky rate cut before Christmas to try and get the consumer confidence up a little bit going into Christmas. But based on what you said yesterday, it's still looking, unlikely, and maybe it's only a little bit. But we are definitely getting closer to the point where they cut rates.
Yeah, so because I think inflation, correct me if I'm wrong, I think like annualized inflation at the moment is just under 4%, 3.9%, I think it is. And as you said, the RBA's target band. So basically what they're trying to bring inflation, the band they're trying to bring it into and keep it in is between 2 and 3%. So does the RBA need to see inflation get back into that band before they reduce rates, or potentially can they reduce rates on the expectation that that's where inflation is headed, and we can see that rate cut before inflation is actually, back down there?
Well, you can see it before there's the actual print. Inflation in Australia is quite backward. It's reported on really on a quarterly basis properly, and it's sort of in the rearview mirror. So if the trend is heading in the right direction, and they're confident, and you can see other signs of potential capacity building in the economy, slowing retail sales, etc., then they certainly can move ahead of actually getting the print under 3. But they want to see that trend continue, and unfortunately, last month we've just seen the persistence at that high 3s level They really want to see that keep falling quite quickly. So yeah, if all of a sudden it starts turning back down and we get to 3.2 when we're heading in the right direction, then I think there's enough cover for them to ease.
Yeah. Okay. Moving to the US, because interest rates are also topical in the US. Their economy's been in the headlines this week. Off the back of, I guess, markets being a little bit spooked. We've seen some headlines around a possible US recession. I think unemployment's kicked up a little bit there. So maybe speak to those headlines around the possibility of a recession. Is that are they appropriate headlines? Are they a bit overblown? How are things going in the US? And are they likely to see some rate cuts potentially in the very near term?
Yeah. So the first thing, the US Federal Reserve, their central bank met last week and kept rates on hold. So they're on hold for another month. The next meeting's in September, where they did flag last week that it's likely you're going to see a rate cut in September. And certainly since then, with market volatility and the economic data, we think that's really likely. The question is whether it's 0.25 or 0.5 now, as opposed to whether there's a cut at all. So yes, they're getting cuts. There were some recession headlines, really driven by job numbers on Friday night. So payrolls showed slower growth in payrolls, and I say that payroll still increased, just not as much as expected. But that then basically pushed the unemployment rate higher. So more people looking for a job than more jobs created creates a higher unemployment rate. So context here is that unemployment is coming off really low levels. So you had a really strong economy, really strong employment, and we're sort of just getting back into the normal band. So at 4.3, we're somewhere in the neutral level of that sort of 4 to 4.5%, where there's enough slack in the labour market that wages aren't growing too quickly, which means inflation's not a problem. But equally, you're not in recessionary territory. The reason that everyone got hooked on the recession headline is because there is this thing called the SARM rule, which all of a sudden is getting all of these headlines. What is that? Claudia Sarm was a researcher at the Federal Reserve. So she worked at the central bank and she studied all previous recessions in the US and basically determined that when the unemployment rate increases by 0.5% off the lows of the last 12 months, that a recession ensues. And it's not an investment rule, albeit investing through recessions can be challenging. It's an economic rule designed to set policy. But Claudia herself has been out in the papers saying that this time she thinks because of the makeup of the labour market that maybe the rule doesn't apply, and so on and so forth. And so what we're seeing in real-time growth barometer, so nowcast of growth, data actually came out on Monday night for the really important services sector. So in developed economies like the US, Australia, services makes up sort of 2/3 of the economy. We saw a sharp expansion in activity, new orders increase. So there's other, and if you look at sort of real-time, weekly, daily kind of measurable data, things like how many people are going to movies, to the theatre, to restaurants, are travelling, the economy and the consumer in the US still looks like it's going along pretty nicely, and it doesn't look like it's in recession. We're certainly attuned to the possibility that it's slowing, and we need to keep a close eye on the jobs data. But it doesn't look to us like it's in a recession. So the market's probably just got a little bit ahead of itself on Friday night on that weaker jobs number.
Yeah, well, I mean, that's good to know, and that's one of the takeaways from this conversation, hopefully for our clients. And I think just generally speaking, on the back of COVID, we saw rates rise in the US here and everywhere else, and those rate rises are going to have an effect on the economy, and we're now beginning to see that effect. And those rate rises were primarily designed to target inflation and bring that down from 40-year highs to something sustainable back within the target band for us, 2 to 3% as we're talking about. And you reduce inflation by reducing spending. And as you reduce spending, you slow the economy down. As you slow the economy down, you naturally can expect to see unemployment rise. And in a perfect world, which isn't the one that the Federal Reserve or the RBA is operating in, mind you, ideally, before things slow down too dramatically or unemployment rises too quickly, you put your foot back on the accelerator a little bit by by cutting rates. But, you know, this is a balancing act, and everything's a moving target. So I think what we're seeing here on markets over the past week, over the past month, the talk around interest rates and should we begin to cut and the possibility of recession, these are all pretty natural, and the natural effects of the policy decisions that have been made and needed to be made on the back of COVID, which was just, you know, an historically abnormal time economically, and there was abnormal policy required to address it. And I think all things being equal, when you look at how the US economy has really prospered since COVID, growth, unemployment, inflation, you know, us to a degree, global markets generally. I mean, things couldn't have really gone much better over the last, you know, 4 to 5 years. So I think people can jump pretty quickly at headlines and shadows. And again, it's part of why we do have this catch up every quarter, Tom, which is to cut through a bit of the noise, cut through a bit of the headlines, try and give people a bit of the detail, a bit more context without giving too much and making it overwhelming as well. And appreciate you strike that balance really well. So before I wrap us up, Tom, is there anything else you want to add to the conversation or you think is noteworthy, whether it's from an economic point of view or an investment point of view?
I think it's a period of consolidation. I think you pointed out quite wisely, we're in that phase of having to adjust, and there, from our point of view, what are we looking for? What does the future hold? Well, if there isn't a recession and you are getting rate cuts, it's actually a great time to get invested. And so we'll use volatility as our friend to buy more. Equally, you know, if the outlook changes and the data continues to deteriorate, we can get more defensive. But I would say, you know, stick to your process, stick to your plan, and look past the noisy headlines.
Yeah, absolutely well said. And whenever you see the volatility, I mean, you're doing it there and I'm rehashing it, but it is a time to remind people of just important investment principles. And those pullbacks are healthy. And when there is a pullback, you know, my advice would be go read a book. You know, volatility,
Right.
yeah, volatility is the price you pay to participate in long-term market gains. And share markets forever have and forever will transfer money from impatient people with poorly set expectations to patient people with well set expectations. And that's what you get when you get advice and you've got the right people in your corner that help you set the right expectations. So thanks as always for your time, Tom, for your insight. It's valuable for all of our clients. We get plenty of great feedback on these conversations we have quarterly. If you're a client and you are listening to this conversation today and you feel like you've got reason to reach out to your advisor or one of the associates supporting you because you want to have a chat about your portfolio and or your strategy, or maybe you're just feeling a bit nervous about this or that, that's completely understandable. We are here all year round to fill those questions and have those conversations. So absolutely feel free to reach out. But in the meantime, thanks for watching. Be well, look after your families, and we'll talk to you soon.